Welcome back, accountants. This is now week 5 of 8. You are more than halfway through the class. Congratulations. And we are about to discuss chapters 9 and 10, the next two chapters in the textbook. For chapter 9, we will be talking about accounts receivable. Those are promises that people have made to pay you. You have not collected or received the money yet, but you expect to receive it relatively soon, hence the term accounts receivable. Now, there's something you need to understand for this chapter, accounts receivable, to make sense. The chapter talks about the difference between two different types of allowance or write-off processes. One they call the direct write-off method of valuing accounts receivable, and the other is called the allowance method. Now, what's the difference between the two? Well, let me give you a simple example. Let's say you have 3 different customers, customer A, customer B, and yes, as you expected, customer C. Let's say each one owes you $10. Well, then in total, your total accounts receivable will be $30. Okay, simple enough. If you happen to believe that customer A is just not going to pay you, customer A is going to be a deadbeat, then you might still try to collect from customer A, but you would conclude that the $10 receivable asset that you hold from customer A is probably not worth anything, because after all, you don't expect to collect. And so even though you might continue to try to collect, realistically, if you don't expect to collect your $10 from customer A, you would write off or basically reduce the value of customer A's $10 receivable to 0. And your accounts receivable balance would be $10 from customer B plus $10 from customer C equals $20. And you would have a note. I'm still going to try to collect from customer A, maybe, but I don't think there is much value there. The allowance method is a method that you should use under somewhat different circumstances. What if we hit an economic recession? And what if you say, you know something? During economic recessions, 1 out of every 3 customers tends not to pay. 1 out of 3 turns out to be a deadbeat. Well, if you have 3 customers, A, B, and C, each owing you $10, if the economy becomes worse, then you might say the $30 receivable balance should be reduced to $20 because I'm pretty sure one of my 3 customers isn't going to pay me. But here's the rub. You may not be sure which of the 3 customers will prove to be the deadbeat. Maybe it will be customer A, or maybe B, or the deadbeat might be C. In any of those 3 circumstances, the value of your 3 receivables will only be $20 because one of your 3 customers will prove to be a deadbeat. But if you aren't really sure which one, then you don't know which receivable of the 3 to directly write off, thus reducing that value to 0, thus reducing the value of your entire receivable balance from 30 to 20. So what do? Well, you create basically a fourth receivable, except this is going to be a negative receivable. The receivable, the negative receivable, is going to be called the allowance for bad debts, or the allowance for doubtful accounts. And in my example, that allowance, that negative receivable, is going to be valued at minus $10. If you do that, then you will have technically 4 different receivable accounts. Customer A will owe you 10. Customer B will owe you 10. Customer C will owe you 10. And you will have an allowance for doubtful accounts, which will be valued at minus 10. The total of those 4 receivable balances, 3 customers and a negative allowance. Well, the value of those 4 numbers taken together will be 20, and that is the value of your receivables. The only reason why you're reducing the value of your receivables from 30 to 20 by recording an allowance of negative 10 instead of simply reducing or directly writing off the receivable of the deadbeat is because you don't know for sure who the deadbeat will be. Now, if you go to textbook chapter 9, section 9.2, the allowance for doubtful accounts, and go down to that your turn problem. There are actually different your turn problems in this chapter. The one that we want here is called Heating and Air Company. What's happening here is we believe that we have deadbeats, customers who will not pay us. We don't know which customer will turn out to be the deadbeat, and so we create a negative receivable balance, the allowance. And if you look at answer B and also answer D, you create a negative receivable balance by crediting the receivable account allowance for doubtful accounts. Remember, a credit is a reduction in the value of an asset. And when you are creating a negative asset, you are reducing the value of the assets. Well, if you credit the allowance for doubtful accounts by either $41,570 in answer B, or $20,056.50 in answer D, if you are creating a negative asset, you are reducing the value of your assets. You are not affecting liabilities, and therefore the value of the company is going to go down. That would be a debit to the value account called expense. And that is the most complicated concept in chapter 9. Now let's go on to chapter 10. This is inventory. There's another basic idea that you need to grasp in order to understand the concepts of LIFO, FIFO, weighted average, and specific identification. Those are the 4 different types of inventory valuation methods. In this chapter, I'd like you to look for figure 10.21, where we list out, it's just a small figure, revenues, costs, and margins under those 4 methods. Now, here's the concept. Okay, and let's not look at figure 10.21's specific numbers. Let's focus on the concept. Let's say I'm a retailer and I am purchasing cups and then I'm reselling them. Let's say I purchase a cup today for $10. Let's say I purchase the same cup tomorrow for $11. I now have 2 cups in inventory. One is worth 10, one is worth 11. Total value of my inventory, $21. But keep something in mind. My 2 inventory items, those 2 cups, might look exactly the same. They might actually be physically identical. But we bought one for $10, and therefore it is a $10 asset. And we bought the other one for $11, and then it's an $11 asset. Now, we bought the $10 one first. We bought the $11 one second. Let's say the next day someone comes in and buys a cup. The question is, which cup did that person buy? Well, what difference does it make, you might wonder? They're the same cup. It's just that we bought one for 10 and we bought the other for 11. Well, here's why it makes a difference. If we sold the $10 cup, then the value of our remaining asset is 11. If we sold the $11 cup, however, the value of our remaining asset, the cup that we have not yet sold, is only 10. And so if you're trying to compute the value of your assets, you need to know, did I sell the $10 cup and I still have an $11 asset? Or did I sell the $11 cup? In which case, my remaining assets are only $10. And remember, assets minus liabilities equals value or net worth. If you don't know the value of your assets, you don't know what you are worth. So, there are 4 different ways to solve the problem. Did I sell the $10 cup or the $11 cup? Way number 1. Just keep track of the cups. Put a specific identification sticker on each cup. And when the customer takes one and buys it, make a note of which specific identification sticker is on the cup that you are selling. Thus, under the specific identification method, you will know whether you sold the $10 cup or the $11 cup. Approach number 2. Just assume that you sold the $10 cup. Why? Well, that was the first cup of the 2 that you bought. And you are simply going to assume that the first cup that you bought was the cup that you sold. We call this the FIFO assumption, FIFO, because you are assuming that the first cup that came into your store was the first one that you sold that you sold out of your store. You could make the reverse assumption. You could assume that you sold the $11 cup. Basically, that would mean that the last cup that came into your store, the $11 cup, was the first one that you sold. Last in, first out. LIFO. And finally, you could say $10, $11, what's the difference? I'm just going to assume that if I bought one cup for 10 and I bought the other cup for 11, that each cup is worth an average of $10.50. And so you would just assume that the cup that you sold and actually the cup that you still own are each worth $10.50. If you look at figure 10.21, you see that even though the cup that you sold is bringing in the same revenue because you're selling it for the same price, the cost of the cup that you sold varies based on whether or not you are keeping track of the cost of each specific identified cup, whether you are making a FIFO assumption or a LIFO assumption, or whether you're just taking an average. That concludes our discussion of the inventory chapter, chapter 10. Look forward to seeing you next week in the next module when we move on to review chapters 11 and 12.